Welcome to TheoTrade. This is Don Kaufman. It's March 10th, 2023. There's just about 45 minutes left inside of this trading week, and what a trading week it has been. Ghosts of 2008 return to the markets. Let's explain that and much more here on this weekend update. All right, to begin with, we're looking at the S&P futures. This happens to be none other than an intraday chart. Now, for those of you that were tuned in early in trade today, jobs number comes out. And the jobs number, it was hot. And immediately people said, 311,000 jobs, the market's going to tank. But they didn't see the unemployment rate. Okay, which is the exact opposite. It wasn't hot. It was supposed to be right around 3.4%. It actually jumped to 3.6%. The market actually had a knee-jerk reaction. But here is the absolute key. It actually jumped right to the 39.31. And if you actually tuned in to last night's video, and I did last night's video just to prep you for this, 39.31 we said was going to be prohibitive. Prohibitive it was. Instead of exploding to the upside, we hit 39.31, we danced around it, we came off, we danced back to it, we came back off, and here we are with, again, about 45 minutes left to go. SPOOs are off by 45 handles. It is an absolute crap fest throughout the course of this week in terms of volatility. All right, let's go a little bit deeper in there before I jump in and start talking about the banks, because everybody is talking about, of course, Silicon Valley Bank, which, by the way, is done. Push it aside for just a second. I want you to look at some of the price action, because to me, in the midst of volatility, look, calling the 39.31, it's not about, accuracy. It's about when you are seeing heavy volatility, we gravitate, to key levels. The only key level that was anywhere near us right now was the 39.31, which ironically, if you haven't actually followed us here at TheoTrade, 39.31, that has literally been the central point of trade going back the better part of a year. I mean, I'm all the way back right in this neighborhood back here. Okay, that's April of last year. There you go. It's your entire year basically gravitates in and around the 39.31. Okay, if you were to look right now at like a 200-day moving average, the 200-day moving average is going to be very close to the 39.31. I mean, everything is around it. Now, push it aside for a second. The big question moving forward, and again, when I do these weekend updates, it's about a forward look. Doesn't matter, like, oh, the markets got killed, but there is one important concept, okay? Right back in this neighborhood here, when I'm saying back in this neighborhood here, I'm actually referencing what was a volatility box back in the December timeframe. We've actually dropped back in that vol box, it looks like right now. And I actually want to show it to you on 180-day 4 hour. And when I start talking about like a volatility box, this is what I'm referencing right here, the upper edge of the volatility box. And again, I'm going to be very, very specific here because kind of curious. The upper edge of that volatility box was somewhere around 39.11. The lower edge was literally right around 3,800. Okay. Yeah, we're home. I mean, we're basically in there right now, and you're going to find we might start pinging back and forth. That's if we don't get any more risk. But again, we're going to have to watch this one very, very carefully. Volatility obviously took off to the upside. We'll worry about that here in just a moment. If markets are to rally back early on in the week, if we sound the all clear, obviously, once again, the 39.31 will be the prohibitive level. You get above 39.31, you can actually have a little bit of a breakout rally, but I'm going to be very frank and say to each and every one of you, if you're tuning into this, right, you come back up to 39.31, there's no all clear. You got to burst, okay, north of that. I'm not talking about getting all the way back to 4,000. You just got to get off that 39.31 and break to the upside. That's how prohibitive that's going to be. Right now, unequivocally, risk is to the downside. Let's get to exactly why. All right, one bad bank. That's the question. I entitled this entire weekend update, Ghosts of 2008 Return to the Markets, because obviously 08 was about a financial crisis. This is not about a financial crisis right now, but we absolutely have, okay, a crisis in the making right here, right now. And you need to know where it is, okay, what to be looking at. We cannot withstand one more bank going down. If you're kind of curious about what's going on, all right, let's get down into it right now, and we're actually going to pull up some charts. So when we talk about one bad bank, okay, we are talking about SIVB, which, for those of you that don't know, Silicon Valley, okay, financial group, yada yada. It's done. Okay, when I say it's done, the FDIC actually shut them down. So the regulators came in. That is it. They pulled the ripcord. They are done. And if you have deposits, maybe $250,000 is covered. We'll actually see exactly what the regulators are going to do as they dissolve the entire bank. Okay, so over and done with. But the real crisis is not the one bank. The one bank was a fuse on it. What we now have is a regional bank crisis, okay? Why the crisis all of a sudden? Everything has to do with the fact that if you take a look at something like TYX, all right, TYX, the yield curve shifted on them too quick. The yield curve shifted on them too quick, and we knew that certain banks would take heat if the yield curve shifted too much. And I'm not just talking about, I'm using the 30-year, okay, as a little bit of a proxy. When we start talking about yield curve, though, the short end of the curve exploded higher. The longer end of the curve kind of mellowed out recently, but the short end of the curve kept going up. For the most part, the spread between the short end of the curve and the long end of the curve, okay, is at like 40-year highs. A great way to actually look at that is over here on TasteTrade. Come under futures, go to small exchange. You can actually look at the small exchange product, like the 2 versus the 10. Okay, I mean, it's 100 basis points differential. It was even greater than that. In fact, I was just looking at a chart in this, and you can see the 2-year at one point was all the way above like 5%. I mean, it's just downright wild. It's come down substantially. Nevertheless, okay, that it damaged a lot of the regional banks. So the regional banks just couldn't handle the stress inside of the yield curve. They're starting to snap. Okay, so Silicon Valley Bank goes up in flames. Now, okay, what else do you want to look at? Look at some of the regional banks, all right? I'm going to start with PNC. Now, I wouldn't normally say, PNC. PNC looks like a lot of other charts out there, okay? But I do want to look at like the year-to-date. You can see it's now down about 15%. All I'm trying to show you is smaller banks. Now, PNC is, again, it's not that small, okay, in terms of market capitalization. But right now, the crisis, okay, is underway. You've never heard of SBNK. You're like, well, I don't even know what that is. Okay, yeah, it's called Capital Bank Corp. Apologize, Capital Bank Corp. All right, when I say that the crisis is underway, looks like the marketplace already saw this effectively coming. But when you look at the year-to-date percentage, stocks down 25%. Start opening up a broader chart for 3 years, okay, you'll start to understand a little bit more my concern. We can't have another bank go under. Taking another look, all right, let's actually move on. Moving on over here, this is just Customers Bank Corp. What do we got? You got a stock that's actually getting annihilated here in the last 2 days. Stock's off from the 30 level down to the 20 level, okay? Again, it's a couple of banks that you're probably thinking to yourself right now, whatever, okay? Except how much can the regulators possibly take on if this is to proliferate, all right? Let's go look at MCB because I'm actually showing you Metropolitan from the 55 level down to 40. Again, the year-to-date basis down about 25%. Okay, are we getting interesting yet? Because now we're going to get really interesting. All right, there we go. From roughly the 27 level, effectively down to 12. The stock right now is getting annihilated. It's down 41%. This one looks as bad as Silicon Valley. And again, okay, PacWest Bank Corp. What you're going to deal with is, of course, this weekend, you know, it's Friday afternoon over here. People may actually run the banks, and they're going to look at this and, hey, the stocks are getting absolutely annihilated. Why would you leave your capital in some of these banks at this point? Here's one actually, which, you know, again, you know, Signature Bank, have I heard of it? Maybe once. It's off the 100 level, down to 60. If you look at the year-to-date percentage, getting absolutely annihilated down about 40%. Are they still in business at this point? Absolutely unequivocally, yes. Okay. Over the weekend, though, we'll see. This is where you can get runs in the banks, and you have to be aware of it. Okay. What I actually put for the next bullet point, there needs to be an immediate resolution, or what I term Panic at the Disco. I'm going to tell you right now, I don't think there's going to be an immediate resolution. Immediate resolution would actually be someone like the Fed, okay, and regulators stepping up this weekend, not next weekend, not next week, okay, this weekend. You come in this weekend, try to stabilize the regional banks, okay? Fuel them with a little bit of capital. Yeah, we're talking about effectively bailing them out. We don't want to call it that. We'll call it stabilization. They don't come in and stabilize them. We may see what I'd term panic at the disco next week, because this is something that's just not going to go away. If they're going to hemorrhage because of the yield curve, okay, the Fed's actually going to push the yield curve even harder. Meanwhile, that yield curve, oh man, this is not good, because you actually have got the bonds just soaring right now to the upside. This, okay, is one of the critical portions of the trade, I think, that makes me nervous. I'll come back to that in just a second. So we just showed you a couple of regional banks. That happens to be, as I call it, like, ghosts of 2008. It's like an echo of 2008. But this one, it's not a mortgage crisis of any kind, all right? It's yield curve. And it's completely and utterly a Fed-induced crisis, right? They jammed the yield curve too quick. Something had to break. Well, something broke. I mean, that's what this comes down to. Something broke. You knew something was going to break. And a lot of times when you start moving financial instruments, it's the financials, okay? And the financials, sooner or later, we're going to snap. For those of you that have actually tuned into TheoTrade for any considerable period of time, okay, my number one short, what is it? It's financials, everything from JP Morgan to Wells Fargo, okay, to, well, short 1,200 shares of, XLF. And this is just one account. I'm in a multitude of short positions inside of the financials, because I keep saying, if there's going to be another leg lower inside of the S&Ps, it had to come from those financials. But at this point, the question is, okay, are we going to keep this just the financials? Well, of course not. It's going to bleed over to everything. And that's exactly, okay, the trade that you're presently seeing. Okay? And the other thing you have to think about, like Silicon Valley Bank, there's some really nasty repercussions going on there, not because of the bank, but ultimately because it represents a huge amount of like VC funding, private equity, dead. You're a company right now looking to get funded, it's over. It's over at this point. You're going to actually see a crisis of confidence, I believe, in the Silicon Valley and funding startups and so forth. I mean, you're going to have a lot of startups in just the next couple of weeks. You're going to see not going to be able to make payroll. All right. So it's on right now. There's no question. When it comes to some of these regional banks, though, they're going to save them. They're going to actually, infuse capital into them, or we're going to actually see a little bit of panic. Because again, if you never looked at this, PACW, okay, would you want to leave your capital in there over the weekend? You answer that, not me. You look at the stock price. I'm sorry, I'm not comfortable with it. Like, I wouldn't leave my capital in there. That thing would be transferred out, probably one of the brokerage houses, which are not as negatively influenced from the yield curve. Anyway, onward and upward. Another area that I'm carrying a big short position happens to be none other than the Russell. And the Russell got annihilated this week. If you take a look, the Russell, I want to show you a year to date, because one of the most interesting things that a lot of people are not talking about is you realize the Russell was actually pretty much your top performer in here, up, okay? Upwards of 15% year-to-date basis, now massively unchanged. What a difference 1 week has made. You realize this thing this week has fallen. It was basically up 11%, has fallen about 10% on the week. So the Russell's in full-blown, you want to call it correction mode? It's already a bear market, but it's horrendous out there. There's another cool way to look at this in terms of the IWM. Bring up auto expected moves. And the reason I wanted to bring up the auto expected move, the move that was implied this week, again, the move that was implied this week, so it started the week just roughly around like, 191, the lower edge of the expected move was somewhere around like 186. It's about a $5 expected move. Actual move, remember, it started at 191. It's down here at like, 175. Yeah, 3 deviation move. Okay, that's how you just roughly figure out. It's a 3 standard deviation move. It's absolutely horrendous over there. The Russell crushed. The Russell, okay, that's just a side effect because the Russell's actually filled with regional banks. Okay, the thing that has me much more concerned is the movement inside of the bond market. The movement in the bond market, the shift specifically, forget about the 10-year for a second. The 10-year is alarming, okay? But the 30, the 30 is an absolutely monumental move to the upside. This is the kind of move that unto itself, right, indicates what? It's risk. Like, why would anybody want to buy a 30-year right now? Because there's just nowhere else to really put your capital where you're going to feel warm and fuzzy. And that's what it comes down to. Like, you start thinking about the 30-year long and hard. Why do you want to buy a 30-year? Okay, and I'm serious about this. Look at the TYX. Somebody says, why do you want to buy a 30-year? Okay, what do you mean? Why do I want to buy a 30-year? Look, The 30-year right now is yielding about 3.7%. Okay. The 2-year is what? Okay. Go look. Well, the 2-year is actually sitting closer to 4.6%. So why are they buying the 30-year? Because crap is that bad. And that is exactly why I said there's a bit of fear out there, right? Because when you start seeing this, it's downright scary. In other news, let's go look at the volatility futures. Forget about the 12-day vol futures. They're done, right? You got to look at actually a little bit longer duration over here, and you're going to see, and I'm just going to highlight this for a brief moment, okay? You're going to see very mildly that we're in a backwardation. The 40-day volatility futures are sitting at 24.62. The 68-day volatility futures are sitting at 24.50. It's mild, but there is a backwardation, which means, okay, risk is imminent, risk is now. They're probably going to end, okay, this week basically flat, but it is a stark contrast to anything that we've seen in some of the recent trade. All of a sudden, seemingly out of nowhere, okay, we're just cruising along over here, nothing's going on in the market, and snap, something breaks, volatility futures invert, everybody's buying long-term, like, you know, paper, which is bonds, okay? You're looking for the dollar to rally? No, the dollar is not rallying. Okay, in this crisis, we don't like dollar. No, and now we're back to the bonds and volatility. Okay, speaking of volatility, I think it's actually worth mentioning VVIX. All right, did you see what VVIX did today? It's got to be a little bit of a misprint, right? But it's not. VVIX soared all the way to 126 today and actually contracted back. But I just wanted you to see, put on your big boy pants, because it's getting real, and it's really, really vicious out there. No question about it. All right, the compound issues. If you take a look at the SPX, the mother of all products. So, of course, we look at the expected move. We're going to come to that. That's not why I'm bringing up the SPX. I'm bringing up the SPX for a very, very different reason. Reason I'm bringing up the SPX, okay, now I was talking about this already last night, but the SPX, this one's going to be interesting. CPI is coming out, and I just wanted to show you that the Monday expiration has a 20% implied volatility and almost a $56 move. The Tuesday expiration, $90 of expected move, so almost a 28 vol. People, okay, enter CPI. It's gonna get wild. Okay, and I call it oh my CPI, because we are going to have one very wild week coming up. No questions about that. All right, next, let's talk a little bit about get your trade on, trades that we've got on, trades that we're thinking about putting on, trades that we took off profitably. First of all, I'm going to bring up Catapult. Why am I talking about Catapult? If you have no idea what Catapult is, okay, well, you should learn. For those of you that don't know what Catapult is, I go out and I sell S&P, for instance, options on futures. And I use the capital from the option on future, okay, to finance other trades. Well, up until like, this week, nothing was really working. All of a sudden, Starbucks up like 100%, and the QQQ is right on the dance floor, okay? And the Apple trade is massively unchanged. Like, you have to understand these Catapults, I have paid nothing for them. I've paid nothing for them, and they're all starting to come to fruition. Here's actually what I call little Catapult portfolio. The little Catapult portfolio has XHB. It's starting to make money. The Tesla spread has gone in the money. The QQQ spread is working over here. We're batting 1,000 inside of Catapult right now. So it's working. Onward and upward. We actually closed an in-out spread in JP Morgan. About a 60% gain in there, obviously, because the financials tanked. I just put on an NVDA, okay? NVIDIA spread today, and you're like, well, why? One thing interesting to me about a marketplace that's getting tagged, and this marketplace, okay, you could say a lot of things about the marketplace, but you're going to say, look, the S&Ps are getting hit pretty good out there, and no question, they're down another, 1.3%. I like to find stocks that are not getting killed and short them. Why? Because if we continue to go down in the S&Ps, believe me, they're going to hit them all. And that's exactly what you're going to see inside of NVIDIA. It was well worth the in-out spread. I covered a bunch of positions. Covered means closed. And when I close something, I close it for a minimum of 50% gain. I close the spiders, the QQQs, okay? Some S&P options on futures, some S&P options on micros, all closed. I mean, I closed a ton of inventory early in the week. Because early in the week, okay, we were off of a bounce from last week. Okay, on Monday, we actually bounced a little bit inside of the S&Ps. Yeah, That was here, okay? I actually closed puts. Next thing I know, we tumbled down and I'm closing calls left and right. Then I turned around, okay, and I unloaded. I sold some premium, right? Sold some premium yesterday, sold some premium today. It has been a premium free for all. I mean, premiums are up. No question about it. The VIX, for those of you, it's at the highs of the year. And yeah, it got all the way up to 29 and backed off. But I'm going to tell you right now, volatility, okay, we're not done. As I said, they either need to contain this immediately, an immediate resolution, okay, or we're likely to see pending issues next week. As I said, the ghost of 2008 returned to the markets. Last but definitely not least, let's talk once again about the SPX, the mother of all products. So the SPX, and I'm going to zoom in very, very tightly to this so everybody gets a quick feel. This is expected move. It's the option market handicapping forward risk. And the expected move was plus or minus $78. Says it right there, $78. Okay. We started the week right around, and I'm just rounding it here. We started the week right around 40.50. Where are we presently trading? Oh, let's call it 38.60 and change. Okay. Actual move? Yeah, a little bit bigger than 78. What we're actually looking at here is about a 2 standard deviation move, 2 sigma move. Okay. Not insane, okay, but definitely one of the larger moves that we've seen in kind of recent history. Have we seen a lot of 2 sigma moves? Last year we saw all kinds of them, but the last time we had a really violent move to the downside, you come back to right when we dropped into the volatility box, right? So dropping into that 3,800 volatility box is the last time we basically saw like a 2 sigma move, but it's been a while for a full-fledged 2 sigma type move inside of the SPX. So I caution you, how significant and serious, okay, the move on the screen happens to be, okay? And do not be surprised. Like, look, as I said, like no one wants to go home long this weekend. You're looking for the rally back. I'm looking for the rally back, but then you start to come to the conclusion, no one wants to go home long over the weekend. Why? Because you're going to sit there and be like, I might have to get my money out of my regional bank. Now, what are we looking at next week? Okay, and what are we looking at next week? Back to the SPX for a second. So you see this vicious, all right, 2 standard deviation move. Okay, what's going to amount to basically a 200-point, straight down move inside of the S&Ps. Where do we go from there? For that, well, we consult, of course, the SPX, and it's showing right now about $117 anticipation of movement, which quite frankly, okay, is one of the largest expected moves, right, that we have seen in, again, quite some time. You got to start to come back to some really horrendous trade that we saw transpire back in 2022 to see a 117-point move. There's no question CPI alone, okay, could cause us to easily move 100 handles. We've seen that movie before. But I think at this point, and I said, oh my, CPI. But I'll be very frank in saying, push the expected move aside, whatever you might think. Look, at this point, it is about the regional banks, because what you start to get is we cannot afford for one other bank to sour anytime, okay? This weekend, next week, there can't even be the hint, all right, of one of these other banks going under. I don't care if it's $1 billion market cap or a $5 billion market cap. It does not matter, okay? Contagion is not about, all right, actual plausible risk. In this business, okay, somebody just has to think you're screwed. And you know what? You are. And you got to keep that in mind. All they have to do is have the perception, okay, that you may not make it. You have a run on the bank, and that is it. All right. This is finance 101, people. And you got to realize these regional banks, they're in trouble right now. Again, ghosts of 2008 return to the markets. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.